28 of America's 53 largest housing markets are losing value right now. Every single metro in Florida, California, and Texas is in the red. But here's the twist. The cities your parents called boring are posting the biggest gains in a decade. Today, 10 cities, 5 collapsing, 5 surging, and what it means for your money, your home, and your next move. Number 1 shocked even the analysts. Let's go. Number 10, Tampa, Florida. You pull into Tampa and the skyline looks the same. Cranes still up. New condo towers still going up along the waterfront. But behind those glass facades, the numbers tell a different story. According to Zillow, the average home value in Tampa is $374,888 as of March 2026, down 3.5% year over year. That doesn't sound catastrophic until you realize what it means in dollars. On a $375,000 home, that's over $13,000 in lost equity in 12 months. And it's not slowing down. Redfin's data shows Tampa posted the steepest price drop among the 20 cities tracked by the Case-Shiller Index. 12 consecutive months of annual declines. Active residential listings are up nearly 15% year over year, according to local MLS data, and the market is sitting at roughly 8 months of supply. For context, a balanced market is 5 to 6 months. Tampa is deep into buyer's market territory. So what happened? The pandemic boom hit Tampa like a freight train. Remote workers from New York and Chicago flooded in. Prices doubled in some neighborhoods between 2020 and 2022. But mortgage rates went from under 3% to over 6.5%. And suddenly, the math didn't work anymore. Add Florida's insurance crisis. Premiums up 30 to 40% since 2022. And the monthly cost of owning a home in Tampa became brutal. A $400,000 house with taxes, insurance, and a 6.5% mortgage can easily run you $3,500 a month. That's more than a lot of people's take-home pay. Here's what this means for you. If you own in Tampa and you're thinking about selling, the window is getting smaller. Every month of rising inventory means more competition and less leverage. If you're thinking about buying, you've got negotiating power you haven't had since 2019. Sellers are accepting offers 3 to 4% below asking. But, and this is the big but, don't just look at the sticker price. Calculate the full monthly cost: mortgage, taxes, insurance, HOA, if applicable. That number is what actually determines whether you can afford it. Realtor.com projected Tampa Bay prices could decline another 3.6% through the rest of 2026. That's not a prediction of doom. That's a prediction of opportunity, if you're paying attention. The craziest part? They're still building. New condo towers are going up, while existing ones sit empty. It's like opening a new restaurant in a food court where half the tables are already vacant. We stay in the South for number 9. Different state. Same problem, but worse. Number 9. Memphis, Tennessee. Memphis doesn't get the headlines that Miami or Austin get. No one's filming TikToks about the Memphis housing crash. But quietly, this city is in deeper trouble than most people realize. According to Realtor.com, the median listing price in Memphis dropped 13.1% year over year in February 2026. 13%. Active inventory surged 22.5% in the same period. And Zillow puts the average home value at $144,710, down 3.1% from last year. That's one of the lowest median values among major metros in the country. But here's what makes Memphis different from Tampa or Austin. This isn't a correction from a pandemic boom. Memphis never really boomed. Prices went up, sure. AEI data shows Dallas gained 64%, and Austin doubled from 2019 to 2022. Memphis gained a fraction of that. So when prices started falling, there wasn't a giant cushion underneath. People are losing equity they barely had. The real story is what's happening to the neighborhoods. Memphis Magazine ran a piece in March 2026 about absentee landlords buying up homes as rental properties, then neglecting them. Once stable neighborhoods are deteriorating. Whole blocks where nobody who lives there actually owns the house. That's not a housing market. That's extraction. And the foreclosure picture isn't helping. ATTOM's Q1 2026 data shows foreclosure filings nationwide rose 26% year over year. Tennessee is one of the states feeling it hardest. When your median home value is $144,000 and your income hasn't moved, even a small rate increase can push a family over the edge. So what do you do if you're in Memphis? If you're an owner, the honest answer is hold if you can. Selling into a market with 22% more listings and 13% lower asking prices means you're competing with every other desperate seller. If your mortgage is manageable, stay put and wait for the cycle to turn. If you're a buyer looking at Memphis as an investment, be extremely careful. Low prices attract investors, but the rental income has to justify the purchase. And in neighborhoods with rising vacancy and declining quality, the math falls apart fast. One more thing. For every absentee investor buying a house in Memphis for $120,000 and renting it out for $1,100 a month, there's a local family that got outbid. That's the part nobody talks about. Number 8 takes us to a city that was supposed to be bulletproof. Number 8, Denver, Colorado. Denver was the golden child. Mountain views, tech jobs, craft breweries, and a population that just kept growing. For a decade, you couldn't go wrong buying a house in Denver. Those days are over. According to Realtor.com's January 2026 data, the median listing price in Denver dropped to $500,000, a 7.4% decrease year over year. The Denver Post reported in March that starter homes, the bottom third by price, are averaging a 6% decline in value. Mid-tier homes are down 4.3%. This isn't a correction at the top of the market. This is hitting the people who can least afford to lose. Inventory is climbing. The Colorado Association of Realtors reports active listings are up significantly heading into spring 2026, with the average close-to-list ratio sitting at about 98%, meaning sellers are already giving back money at the negotiation table. And the migration numbers that powered Denver's boom? They've slowed dramatically. People are still moving in, but not at the rate that justified 2021 and 2022 prices. The mechanism here is simple, but painful. Denver got expensive fast. The average home went from roughly $400,000 pre-pandemic to over $600,000 at the peak. At 6.5% mortgage rates, a $600,000 house costs about $3,400 a month before taxes and insurance. After taxes and insurance in Colorado, you're looking at $4,200 to $4,500. That prices out a huge portion of the workforce: teachers, nurses, police officers, the people who actually keep a city running. Here's the actionable piece. If you bought in Denver between 2020 and 2022, you might be sitting on less equity than you think. Check your home's current value on Zillow or Redfin. Subtract what you owe, and be honest about where you stand. If you're above water and planning to stay long-term, you're fine. Markets cycle, but if you were counting on that equity for a downsize, a move, or retirement funding, recalculate now, not later. If you're looking to buy in Denver, starter homes are where the deals are. A 6% drop on a $350,000 home is $21,000. That's not nothing. But make sure you're buying for the long game, not trying to time the bottom. The irony? Denver spent years being the city everyone wanted to move to. Now it's becoming the city a lot of people can't afford to stay in. The mountains haven't moved, the price tags have. Number 7. We're going back to Florida, and it's ugly. Number 7. Cape Coral, Florida. Cape Coral has the worst home price decline of any major metro in the entire United States right now. That's not opinion, that's the American Enterprise Institute's data. Negative 9.6% year over year as of February 2026. Worse than Austin, worse than Tampa, worse than anywhere. According to Redfin, the median sale price in March 2026 was $352,000, down 4.6% from last year. Zillow puts the median sale price even lower at $355,067, with a sale-to-list ratio of 0.962. Meaning sellers are getting roughly 4% less than their asking price. There are over 3,300 homes for sale as of March 31st. The market has more than 12 months of inventory, according to earlier estimates. A balanced market has 5 to 6. Hurricane Ian was the catalyst. Category 4, September 2022, $113 billion in damage. Thousands of homes flooded, and those properties poured onto the market. But the storm didn't cause this. it exposed it. Cape Coral had been growing too fast, building too much, and depending on one selling point: the canals. The largest canal system of any city in the world, bigger than Venice. That used to be the main attraction. Now, those canals are the reason insurance companies are running away. Insurance premiums in Cape Coral run $5,000 to $6,000 a year for a typical home, according to Florida Insurance Institute data. 2 major insurers pulled out of Florida entirely in 2025. A lot of homeowners didn't find out until they tried to renew their policy. Add property taxes, and you've got what I call the invisible second mortgage, a $1,200 to $1,500 monthly bill on top of your actual mortgage that never goes away and only goes up. If you're thinking about buying in Cape Coral, the price is tempting, but sit down with a calculator first. A $350,000 house at 6.5% is about $2,200 a month in principal and interest. Add $500 for taxes and $500 for insurance, and you're at $3,200. For a house that was worth $390,000 a year ago and might be worth $320,000 next year. That's catching a falling knife. If you already own here, check your insurance policy right now. Not next week, right now. Make sure your carrier is still in business and your coverage matches your replacement cost. The worst thing that can happen isn't the storm. It's finding out you're uninsured after the storm. Cape Coral's famous canals, the thing that made this city a destination, became the thing that made it uninsurable. Sometimes your best feature becomes your biggest liability. Number 6 is the big one, the poster child for this entire correction. Number 6, Austin, Texas. Austin doubled in price during the pandemic. Let that sink in. According to AEI data, the average home went from $297,000 in Q4 2019 to $593,000 by Q2 2022. 100% appreciation in 2.5 years. That doesn't happen in a normal market, and what goes up that fast has to come down. As of April 2026, the Austin MSA median sold price sits around $440,000, roughly 20% below the May 2022 peak of $550,000. That's $110,000 in lost value. Zillow shows the average home value at $508,530, down 5.7% year over year. KXAN reported the March 2026 median for the metro at $426,220, down 3% from March 2025, and the lowest March median since 2021. This is the 4th straight year of price declines. The mechanism is oversupply. Texas builds. That's what Texas does. There are no geographic constraints like in San Francisco or New York. When prices shot up, builders floored the gas pedal. Now there are developments across the Austin metro sitting half empty. Inventory is approaching 8 months of supply. New listings are competing with resales that are competing with builder incentives. Some builders are offering $30,000 to $50,000 in incentives, rate buy-downs, closing cost credits, upgrades, just to move units. But here's the nuance nobody talks about. Austin, at $440,000, is not a crisis for someone who bought in 2018 at $300,000. They're still up 46%. The crisis is for the people who bought at $550,000 in 2022, with 5% down. They put $27,500 into a house that's now worth $110,000 less than what they paid. They're underwater. They can't sell without writing a check. They can't refinance because there's no equity. They're stuck. What should you do? If you bought at the peak and can afford your monthly payment, don't panic sell. Austin's fundamentals, jobs, population growth, tech sector, haven't disappeared. The price correction is real, but so is the long-term trajectory. If you can hold for 5 to 7 years, you'll likely be fine. If you're looking to buy, Austin in 2026 is the most buyer-friendly it's been since 2019. But buy for the right reasons, because you're staying, because the payment makes sense, not because you think you're catching the bottom. An Austin home that cost $550,000 in 2022, financed at 2.8%, had a monthly payment of about $2,250. That same home at $440,000 today, financed at 6.5%, costs about $2,780. Cheaper house, higher payment. That's the trap of the rate environment. The sticker price means nothing without the interest rate. Now, we flip the script entirely. Number 5 through number 1, the cities nobody was watching, the ones that just won. Number 5, Louisville, Kentucky. Nobody moves to Louisville for the hype. There's no influencer scene, no crypto bro migration wave, no TikTok videos about Louisville is the next Austin. And that's exactly why it's working. According to Zillow, the average home value in Louisville is $261,482, up 2.4% year over year as of March 2026. The Louisville Association of Realtors reported a median sale price of $285,085, up over 4% from the year prior. And here's the stat that caught my eye. New listings surged 23% in January 2026 compared to the same month last year. That sounds like a warning sign, right? More supply usually means softening prices. Not here. In Louisville, that supply is getting absorbed. Homes are still selling in 48 days on average. Demand is meeting supply, not drowning in it. Why? Because Louisville is affordable, and people are discovering that matters more than palm trees. The AEI data shows Louisville gained just 25% to 33% during the 2019 to 2022 boom, while Sunbelt cities were gaining 50 to 100%. That restrained growth means Louisville never got overpriced. It never built the bubble that needs to pop. The city ranks 8th among the best large housing markets for homebuyers in 2026, according to WHAS 11 News citing Realtor.com data. Only 9.3% of homes sold above asking price in January. Compare that to pandemic-era bidding wars, where 50% of homes went over ask. Louisville is a market where you can actually negotiate, actually get an inspection, actually think before you buy. Here's the practical takeaway. If you're priced out of Nashville, which is 2.5 hours east, Louisville offers a similar quality of life at roughly 40% less. Median household income in Louisville supports a $285,000 home purchase, far more comfortably than a Nashville median of $450,000 plus. The math just works. And Louisville isn't just cheap. It's a city with a real economy. Healthcare at U of L Health and Norton, logistics with UPS's Worldport hub at the airport, bourbon tourism that pumps hundreds of millions into the local economy. This isn't a one-industry town hoping for a miracle. The lesson from Louisville is simple. The cities that didn't spike are the cities that don't crash. Boring wins. Number 4 is another Midwest city that just cracked Zillow's top 10 hottest markets list. Bet you didn't see this one coming. Number 4, Milwaukee, Wisconsin. Milwaukee, the beer city? The city people fly over on their way to somewhere warmer? Yeah, that Milwaukee. It's outperforming nearly every major market in the country right now. Zillow shows the average home value in Milwaukee at $220,137, up 3.6% year over year as of March 2026. But that's the city number. The metro area, Milwaukee, Waukesha, West Allis, tells an even bigger story. According to the Milwaukee Journal-Sentinel, the median home price is expected to rise another 5% in 2026, following a 6.1% increase in 2025. Milwaukee County itself saw a 9.9% price jump last year. Nearly 10% in 1 year for a city most investors weren't even looking at. Zillow ranked Milwaukee as one of the top 10 hottest housing markets for 2026. Inventory sits roughly 25.7% below pre-pandemic levels. That's the opposite of what's happening in Tampa or Austin, where listings are piling up. Milwaukee doesn't have enough houses, and when demand outstrips supply, prices go up. That's not speculation, that's gravity. The AEI data confirms Milwaukee at plus 5.6% year over year through February 2026, putting it firmly in the top tier nationally, while 28 of the 53 largest metros were posting declines. So what's driving this? Affordability. At $220,000, Milwaukee is roughly half the price of Denver and a third of the price of San Francisco. Remote work didn't just push people to Austin and Miami. It pushed people to places where $2,000 a month actually gets you a 3-bedroom house with a yard instead of a studio apartment. Milwaukee is one of those places. If you're considering Milwaukee, here's the honest assessment. You're not going to double your money in 2 years like people did in Phoenix in 2021. That's not what this market does. What it does is appreciate steadily, 3 to 6% a year, while you actually live comfortably on a normal salary. Your mortgage on a $220,000 house at 6.5% is about $1,390 a month. Add taxes and insurance in Wisconsin, and you're around $1,900. That's manageable on a household income of $65,000 to $70,000. Try that in Miami. The risk? Milwaukee winters are real. The city has infrastructure challenges. Some neighborhoods have quality issues with aging housing stock. Go in with your eyes open. Get the inspection. Check the basement for water damage. But the fundamentals, price, demand, low inventory, are all pointing the right direction. One Reddit user in the Milwaukee subreddit posted fresh MLS data on March 1, 2026. Prices are already up quite a bit, and we haven't even hit spring. That's the sound of a market with momentum. Number 3. Stay in the Midwest. It gets better. Number 3. Cleveland, Ohio. Cleveland is having a moment nobody predicted. The city that became a punchline, at least we're not Detroit, is now one of the hottest real estate markets in the United States, and the data isn't even close. The AEI report puts Cleveland at plus 5.9% year over year through February 2026. That's the third highest appreciation rate among the 53 largest metros, while most Sunbelt cities are deep in the red. Fox 8 Cleveland reported a 7.4% price increase heading into 2026, with momentum carrying into the new year. Norada Real Estate called Cleveland the hottest city for real estate investors in 2026. And the reason is almost too simple. Cleveland is cheap. Absurdly, historically, stubbornly cheap. According to Zillow, median home values in Cleveland proper hover in the low $100,000. In the metro area, you can find solid 3-bedroom homes for $180,000 to $250,000. At a time when the national median is above $400,000, Cleveland is operating in a completely different universe. But cheap alone doesn't explain a 6% surge. What explains it is the shift the AEI calls the affordability economy. Buyers, first-timers, remote workers, investors squeezed out of coastal markets are looking at the math and making rational decisions. A $200,000 house in Cleveland with a 6.5% mortgage costs about $1,265 a month. In Cape Coral, that same payment gets you roughly nothing right now. The monthly cost is what drives decisions, and Cleveland's monthly cost is among the lowest in the country for a real city with real infrastructure. The Cleveland Clinic, one of the largest employers in Ohio, isn't going anywhere. Neither is the manufacturing base, the universities, or the growing tech scene downtown. PwC flagged Cleveland in its Emerging Trends in Real Estate report for 2026, noting projected per capita income growth. Here's the honest take for buyers. Cleveland is not a guaranteed appreciation machine. The city has real challenges. Population has been declining for decades, though it's stabilizing. Some neighborhoods have significant vacancy and blight. You need to know the city block by block, not just by zip code. But if you do your homework, the value proposition is extraordinary. You can buy a home, live comfortably, and build equity without being one paycheck away from disaster. For investors, Cleveland rental yields are among the highest in the country. A $150,000 property renting for $1,300 to $1,500 a month is common. That's a cap rate that coastal investors dream about. Just make sure the property is in decent condition and the neighborhood is stable. Cleveland spent 2 decades being ignored, while everyone chased sun and speculation. Now, the sun markets are correcting, and Cleveland is still standing. Funny how that works. Number 2 is right down the road, and its numbers might be even better. Number 2, Pittsburgh, Pennsylvania. Pittsburgh has been quietly reinventing itself for 30 years. Steel mills closed. The city nearly collapsed in the 1980s. Population dropped. And then something unexpected happened. It rebuilt around healthcare, education, technology, and robotics. Without the speculation, without the hype, and without the bubble. The AEI report ranks Pittsburgh at plus 5.8% year over year through February 2026. That makes it the fourth best performing major metro in the country. Zillow shows the average home value at $237,533. And here's the interesting part. It actually dipped 0.4% recently, which might seem contradictory, but that dip is hyper-local to certain areas. The broader Pittsburgh metro, according to AEI and Realtor.com data, has been consistently in the growth column. Realtor.com named Pittsburgh one of the top housing markets for 2026, noting it's still about 31% below pre-pandemic supply levels. That means there aren't enough houses. Buyers are competing, but not in the insane way they competed in Phoenix or Boise. There are no waived inspections, no $100,000 over asking. It's competitive, but sane. That's the sweet spot. What Pittsburgh has that most growing cities don't is diversification. Carnegie Mellon University and the University of Pittsburgh anchor a tech and healthcare ecosystem. UPMC is one of the largest nonprofit health systems in the country. Google, Amazon, Apple, and Meta all have offices or significant operations in Pittsburgh. The robotics and autonomous vehicle industry is centered here. This isn't a city banking on one employer or one trend. It's layered. For buyers, the math is compelling. A $240,000 house at 6.5% runs about $1,517 a month before taxes and insurance. Pennsylvania property taxes are moderate, averaging around 1.5%, so add roughly $300 a month. Insurance in Pittsburgh is not Florida. You're not dealing with hurricane risk or flood zone nightmares. Total monthly cost, roughly $2,000 to $2,200 for a house in a functioning metro area with actual career opportunities. The flip side? Pittsburgh is hilly. Some neighborhoods are hard to navigate. Winters are cold and gray. Not Milwaukee cold, but not pleasant either. And the housing stock is old. A lot of homes were built in the early 1900s. That means charm, but it also means updated plumbing, new electrical, and possible foundation issues. Budget for inspection and repairs. Here's what's happening at a macro level. The pandemic reshuffled the deck. Remote workers flooded the Sun Belt and drove prices to insane levels. Those prices are now correcting. Meanwhile, cities like Pittsburgh, cities with real jobs, affordable homes, and no speculative bubble, are finally getting their due. It took a housing correction for America to notice what Pittsburgh has been building for decades. Ed Pinto at AEI put it perfectly. We've entered the affordability economy. Pittsburgh is the affordability economy personified. Number 1, the biggest surprise on this entire list, the city with the highest appreciation in the country. It's not where you think. Number 1, Kansas City, Missouri. Kansas City just posted an 8.6% home price increase in the last 12 months. That's the highest of any major metro tracked by the American Enterprise Institute. Higher than any city in Florida during the boom. Higher than anywhere in Texas, California, or the entire Sun Belt. Kansas City, Missouri, barbecue capital, middle of the country, zero hype, is the #1 housing market in the United States of America. According to Realtor.com, Kansas City surged 70 spots in the January 2026 housing market rankings. 70. The Kansas City Star reported a median sale price of $339,780 as of March 2026, up 4.5% year over year. The Ross Group's local MLS data shows the median for existing homes hit $295,000 in February, up 5.4% from a year ago. New construction hit a median of $564,500, up 18.7%. Local inventory sits at just 2.2 months of supply. That's a screaming seller's market. And year-to-date pending sales are up 8.7%. Here's the thing about Kansas City. During the pandemic, while Austin was doubling and Phoenix was up 60%, Kansas City gained 25 to 33%. Conservative, restrained, unexciting. And now, while those overheated markets are giving back 10 to 20% of their gains, Kansas City is adding to its value at the fastest rate in the country. The tortoise beat the hare. It actually happened. Realtor.com flagged Kansas City as the city where buyer demand and below national median prices are creating the perfect conditions for sustained growth. The median home here is still under $340,000, in a country where the national median is over $400,000. That's a 15+% discount to the national average in a city with professional sports, a growing tech sector, a cost of living that leaves actual money in your pocket, and, yes, some of the best food in America. But here's what makes this number one, and not just another affordable city story. Kansas City represents the thesis of this entire video. The AEI calls it reversion to the mean. Fortune called it the affordability economy. What it really is, in plain English, is common sense finally showing up. People realize they can't pay $500,000 for a house that costs $80,000 to build, in a state where insurance costs $6,000 a year and property taxes eat you alive. So they looked at the map, and they found Kansas City. If you're considering a move, Kansas City deserves a serious look. The 2.2 months of inventory means it's competitive. You won't lowball your way into a deal. But compared to any Sunbelt market at its peak, you're getting more house, lower costs, and a market with real upside that hasn't been pumped and dumped by speculation. If you already own in Kansas City, congratulations. Seriously, you're sitting on one of the healthiest appreciating assets in the country. Don't sell to cash out short term. Let it ride. The fundamentals say this has more room to run. The old, boring, Midwest city that nobody wanted. The place you fly over. It just outperformed every beach town, every mountain paradise, every Sunbelt darling in America. And it's not even close. Conclusion: 5 cities crashing, 5 cities climbing, same country, same economy, same interest rates, completely different outcomes. The lesson isn't complicated. The markets that got too expensive too fast are giving it back. The markets that stayed affordable are finally getting rewarded. That's not a crash, that's a reckoning. Check where you stand, know your numbers. The reshuffling isn't coming, it's already here.